Hey friends, Ernie here with the Trader of Futures. Today to surprisingly talk about futures and futures contracts that we trade with. So the first question that many people will want to know is, what are futures? Well, futures are a trading instrument, something that you can trade, just like a stock or an option. Very, in some ways, similar to an option in that it is a contract and it represents something, but not anywhere as complex as an options contract. Options contracts can be extremely complex in the way they work, and also figuring out how to use them, and in the life of the contract. A futures contract, although it is a contract and it represents some underlying asset, gets traded very much like a stock. In other words, you buy it or you sell it. Now, in futures world, it's assumed that you have a margined account, where in the stock world, it's not always that assumption. You may not have a margined account. You may have only a cash account that doesn't allow you to use leverage. In some stock accounts, they'll have up to, depending on how much money that you have in that account, up to 4 times leverage. Most have maybe 2 times leverage. A futures contract may have 40 or 50 times leverage. So, for example, a contract to buy gold, a single contract in the futures world with the symbol GC, that stands for gold, that contract controls 100 ounces of gold. And with the current price of gold around $1,200 right now, that means that you're controlling $112,000 worth of gold. Now, in order to control that $112,000 worth of gold, you have to put up a certain amount of money called margin. And your broker will then remove that money from your account and place it in a place where you can then control that futures contract. So gold, the current margin requirements on gold, well, instead of me, trying to guess exactly what it is, because it does change from time to time. And it's probably worth noting that, let's see, gold, metals. Everything's slow today. You would need $3,100. So if you had $3,100 in your account, you would be able to control $112,000 worth of gold. It's pretty cool. So that means that the amount of money that you have in your account becomes extremely valuable. Now, there are a lot of requirements around that margin, and there's different kinds of margin. There's something called initial margin. That's the amount of margin that you need in order to actually get into that contract, which is a little bit less than that price that I quoted. And then there's the maintenance margin. That's the amount of margin you have to have in your account if you were to hold that gold contract overnight or to the next session. And that's about as complex as futures get. Now, of course, like I said, it is a contract, and so it represents something underneath. In this case, usually an asset. In this case, gold, a commodity. And when you take control of that contract or purchase that contract, you are taking on a certain obligation that if you hold that contract to the expiration date. Now with gold, there are a number of different expirations. Each contract has a certain term. With index futures, for instance, that term is 3 months. With gold, it's a little less. It's like every month, every 2 months. If you were to hold that contract to the expiration date, and now that contract has expired, you would be obliged to take delivery of that 100 ounces of gold. That means that you would have to work up the settlement and the delivery of the actual physical gold. It's no joke. Same thing with oil. I mean, I don't know if you want an oil tanker to show up at the front of your house, but you would be obliged to buy that oil. So for that reason, most people don't hold their futures contracts till expiration. What they'll do is they'll cash them in for cash, or sell them, or buy them back if they were selling them short. So that's a very important point. Now there are some contracts that are cash settled because it doesn't make a whole lot of sense to take delivery on anything, like, for instance, an index future, one that would be controlling, say, the S&P or the Dow, that it's an index. There is no underlying commodity that you can take delivery of. So in that case, it is cash settled. So if you hold it until expiration, then they will figure out, the difference between what you bought it at, what its value was, and they will cash settle it and either add money to your account or take money away. So futures, what is the purpose of futures? Originally, futures were designed for people who are in the business of controlling a commodity, or in the business of that commodity, whatever that business happened. Maybe in agriculture, they would be growing crops like corn. And the futures contract, well, one of the problems with when you're dealing in the spot market and the commodity, that things can get quite volatile, especially in agriculture. Prices can vary wildly. So that the time that you plant a crop to the time that you go to bring it to market, the price of that commodity could have changed dramatically, and therefore upset your expectation on what would constitute profit or a loss. So the futures contract was devised so that you could use the contract and its delivery mechanism to facilitate the delivery of this product, and also to hedge your position so that you could smooth out your operating costs and have some certainty on what your margins and cost would be from the time that you planted that first seed to the time that you brought it to market. And so those people that use futures contracts in that way, in the spot market or the cash market, they're known as hedgers. They're hedging their commodity. And this type of arrangement exists for virtually all commodities, including index futures as well as treasury futures. So from that point of view, it's a very valuable tool for somebody that's in that market, and it helps them make a market. The problem is that in order for those futures contracts to have some kind of worth and validity, they need to be liquid enough. And just having those contracts deal inside the spot market may not be quite enough in order to create a liquid enough market. So they introduced another class of people that would buy and sell these futures contracts for speculation, and they would be speculators. So those are the two different types of people that are actually in this market. There are the hedgers, and then there are the speculators. Now, some people may get confused, this hedging idea, with people who are speculators hedging a portfolio with a futures contract, which you could do. So that's a kind of a term of art. where a hedger is an actual role that someone plays in the futures market. So we are the speculators. We don't take delivery unless, for whatever reason you felt like you wanted to obtain 100 ounces of gold or 1,000 gallons of oil. You're probably not going to take delivery. Now, what is the advantage of the average person for using futures? Well, the first one is what I had said is the leverage that you get. Tremendous leverage. Like with treasuries, you have even more leverage there, where you might have a product like the 30-year bond. It's worth about $140,000 each contract. You're controlling $140,000 worth of treasuries, but it only costs you $1,700 to take control of that contract. Incredible leverage. 50 times leverage, 60, 40, 50, 60 times leverage. That affords you tremendous power. Now, here's the other cool thing. If you traded futures as pairs, this is a very, very effective trading strategy with people who are trading futures. They trade them as pairs. And the reason why they trade them as pairs, in different markets, you will have correlations between those two assets. Like, for instance, there's a very high degree of correlation between silver and gold, or platinum and silver, or between the 10-year note and the 30-year bond, or between wheat and corn, or between soybean and soybean oil, or between crude oil and gasoline, or gasoline and heating oil. All of these things are related products, so they have very tight correlations. And you could trade one long, one short, and then play the fluctuation between them. That fluctuation won't vary very much because they're highly correlated, but every once in a while they get out of whack. And so then you can trade them when that correlation either spreads or narrows to a great degree, and then profit when it returns back or regresses back to the mean price that represents that correlation. And that's the way most speculators actually use future products. Some will trade the outright and just trade it either long or short. And because of the leverage, that is a far more difficult way to trade it, unless you're trading a basket of futures and with each having its own different strategy that is not correlated to the next. And that's something very similar to what I do with the embodiment or the AI setups that I have. And that actually has 300, 400 different strategies that we trade, and we apply them to the different futures products. So then I may hold at any one time 4, 5, 6, 10 positions, each one with its own separate strategy, or had been initiated because of its own separate strategy. And that is another valid way to trade futures. Trading them individually is much more risky because of the movement. I mean, a futures contract can move very quickly, and unless you have sufficient capital in your account, you could very easily wipe out a small account, that's for sure. So anyways, Crypto Shill says, hey, Ernie, nice topic. Brain is exploding with new knowledge. So what I'm going to do now is I'm going to show you the place where you can find all the information that you need to know about futures. Well, I wanted to also make it known that even Bitcoin has a futures product. It's relatively new, just started at the end of last year, December 17th. And there is a Bitcoin futures product that is run by the CME, the Chicago Mercantile Exchange. There's also another one by the CBOE, but most people find that the CME product has much more stability, and it's just a better product, good liquidity. The CBOE product is also good, but in any event, that particular product doesn't have the same kind of leverage that gold or Treasury futures has. It only has about 2.5, 3 times leverage. And that's reflected in the fact that Bitcoin is so volatile. The exchange simply isn't willing to afford that much leverage to something that is so unstable. However, it's there, and it is actually a better way to trade Bitcoin because you get fills immediately. So you buy it, you sell it, you get in and out immediately. You don't have to wait for any transaction. Liquidity is pretty good, so that helps too. You can get in at a price that you intend to get in on. All right, so what I'm going to do now is I'm going to show you where you're going to find all these different futures products. And actually, before I do that, I'm going to just say that there are lots of different brokers that offer futures trading. TD Ameritrade with the Thinkorswim platform, Tastyworks, virtually any of the online brokerages or retirement accounts like Fidelity, Charles Schwab, and others all have futures products as well as stocks and mutual funds and options. Infinity Futures, Interactive Broker. You can go on and on. There's literally dozens and dozens and dozens of people that offer these futures products. And the only way that they'll differ is the level of their support and then also the amount of margin that they actually require on each product. Now, the CME will specify what margin that they recommend, but the broker is not incumbent upon using that exact margin specification, although most of them do. Some will set their own margin limits, usually a little higher, to protect themselves. So they'll make it a little bit more expensive for people to use futures. But most don't. And futures in general are far cheaper to trade than stocks or options. And there is another real big benefit to them, and that is in the profit. Because futures were originally designed for people who are in industry, they wanted to align it greatly with capital gains and capital gains tax structure. So the first 60% of any profit that you make on futures is taxed at the capital gains rate, and then the next 40% is taxed at your nominal tax rate. So right there you get about a 10 to 15% boost in any profit that you make simply from a tax point of view. The other really attractive thing about futures is that unlike stocks, where you need to have at least $25,000 in an account to avoid the day trade rule, where you can get into trouble by day trading a particular asset too many times within a period of 5 days, and then the exchange will, in fact, lock down your account. You won't be able to trade it for up to 90 days. With futures, there is no day trading rule. You can buy and sell a contract with $2,000 or $3,000 in your account. Yeah, I wouldn't recommend that. I mean, I'd want to have enough money in the account, but what I'm saying is that there is no day trade rule in futures contracts. Have I ever heard of a short trader? Nope, I'm not familiar with that. All right, so I'm going to go to the CME group and then show you some interesting stuff. All right, so this is the CME group website. Lots of great information here. There's also training on here. Virtually everything that you want to know about the markets. They also have, like I said, Bitcoin and Ether dollar. Wow, I didn't realize that they already had Ether futures. I don't think they do, actually. I think that's just an index here. But when you get here, you know, I encourage you to take a look. There's a number of great tools here, especially if you're a bond trader and other things. But if you go under the trading menu, this is where you're going to find all the different products. And so over here on the left, they have the most popular products, and then you can go to all the different product groups. Agriculture, which would include things like corn, wheat, soybean, corn, etc. Sugar. Energy, which would include things like natural gas, oil, heating oil, gasoline. Equity indexes that would include futures products for the indexes like the S&P 500, the S&P Midcap 400, the Dow, the NASDAQ, the Russell 2000. Foreign exchange, here's another interesting thing. This is the futures version of Forex products, like the Forex pairs, like the USD Euro or the British Pound or the Aussie Dollar or the Mexican Peso. All can be found here. Interest rates, this includes things that are treasury products, like anywhere from the, virtually everything that you want to trade here. And this is probably one of the biggest markets in the world, actually. You can trade the 2-year, 5-year, 10-year, 30-year treasuries. Then metals, you can trade silver, gold, platinum. And there are options on futures as well. And here's a really cool thing. You can even trade futures on weather. I haven't done this yet. I've been meaning to do it and look into it, but that sounds really interesting. So let's say that we wanted to see what it looks like for equity indexes. And believe it or not, that Bitcoin is actually listed under equity indexes, I believe. Yep, it is right here. Now you notice that there's a code and there's a symbol, just like there are stock symbols for things. The symbol has a root, and then it has 2 other pieces of information that are attached to that. And they represent the specific contract that you're dealing with. So for instance, ES is the root for the E-mini S&P 500 futures. That's the mini futures contract. There's also a full-size futures contract. But ES represents the root. The next letter is the month code for that contract, the month that it expires. Z stands for December. And then the number at the end is the year for that contract. So this is the E-mini S&P 500 contract for the December 2018 contract. Well, they say it right here, contract December 2018, but Z is the contract date. If you wanted to find out, what were all the monthly symbols, you could, I guess you could just do something like monthly futures contract symbols. Just Google it. Here are the month codes right here. There you go. So here's December, Z. Now, not every futures contract now we're back to the equity index products. The equity index products, as a general rule, their contracts last 3 months, and they go from quarter to quarter, December, March, June, September. Where oil, they go every month. There's another interesting way to trade pairs, besides just trading 2 intramarket pairs, or you can also trade intramarket pairs of different month expirations. So for instance, you could do a calendar spread with oil, which is a very interesting way, and you can play different things like contango or backwardation, more advanced concepts. So Ernie, does the equity index for Bitcoin futures have an open and close time, or are they 24/7 like crypto? All right, so that's another very interesting thing. The market session for all futures is pretty much the same across all futures. There is some very, very small exceptions. But the market is not 24/7. However, it is 23/5.5. What I mean by that is that every day during the week, futures are closed between the hours of 5 and 6 p.m. Eastern Time. Now, the market opens up at 6 p.m. on Sunday and closes at 5 p.m. on Friday. So other than that weekend time that it's down, it's also down for 1 hour each day between 5 and 6 p.m. Other than that, it's pretty much open around the clock. So that's a very good question. So let's take a look at the S&P E-mini futures. Every futures contract, what's the great thing about them is that there's standardization. There's standardization on how they are presented, their settlements, time and sales, contract specifications. Now, each contract may have its own specifications, but they all are basically follow the same kind of pattern. And they all have different margins, and the margin is generally computed based on their relative volatility. So this is the quote page for the S&P E-mini futures. Let's go to some of the contract specifications. Here it will tell you the trading hours, but the trading hours are pretty much the same for all futures. Here it will tell you what each individual point is worth, each individual tick. The current margin for the contracts. Wow, they're very expensive right now. $6,000. Now, $6,000 is an awful lot of money to, I mean, in the past, and that reflects, you know, the growth of the S&P. Just last year, this margin was closer to $4,500. So the market has grown, and so the amount of risk there is in there, you know, the total size of the contract and the dollar value and the amount of volatility requires a larger maintenance margin in order to handle that particular security. Well, maybe volume is more interesting. So we can see what the relative volume is of these contracts. So far today, they've traded 2 million, almost 2,300,000 contracts. And you can see that several of different contracts are tradable, but there isn't a whole lot of volume on all of them. There's some volume on March, but all the volume is on December. When you see the one that has the most volume, that is called the front contract, and that's the contract that most people are trading. When I'm doing my AI setups and alerts, we're always dealing with the front contract. So right now for equities and for the ES, that's the December contract. And it's the same way with most currencies as well. So if we were to go to gold, let's go to energy. And we'll take a look at crude oil and its volume. And we can see that with crude oil, calendar positions are very popular. That's why there's a lot of volume on all the different contract months going all the way out to June of 2019. And that's because most people that are trading crude oil are trading it as a calendar spread. But you can trade it on the outright, and it's very easy here to see that November is the front contract because it has, so far today, 613,000 contracts traded. But you can also see that December has 175,000. And then, and look at this, December way out here, 38,000. So they're doing a yearly spread here as well. That's very interesting. Now, a lot of times you can find disparities between the different months as you go further and further out. And there's a lot of money to be made in that difference between these calendar months. Yeah, gold was hit hard. Do you have a preference of what you like to trade on the CME, Ernie? No, I'll trade anything. I like all of them. I mean, they're all great. I like currencies. I like trading pairs. I like trading the treasury pairs. So, for instance, I like the knob trade, which is notes over bonds, or the 10-year note versus the 30-year bond. And that's one of my favorite trades. I also trade something called the crack spread, which is an energy trade, which is a spread between crude oil and heating oil. And then there's the crush spread, and that is a trade trading the soybean versus soybean oil. And these are really cool trades because when you trade pairs like this, the amount of margin that you have to put up is far less than the individual margin that you have to put up for an individual contract. And the reason for that is that they recognize it as a spread where you're going long and short, and there's reduced volatility, so they'll give you a discount, sometimes up to 90%. So, for instance, trading bonds, the 10 versus the 30, I could be controlling $300,000 worth of product for only about $900 of margin. That's incredible. Now, I know you're saying, All says, hey, this is way interesting, way above my head, but it really isn't. I mean, there's a lot of, this is actually way simpler than stocks, because if you start considering stocks and each individual stock and everything that you have to know about that company and earnings per share and everything else, stocks are way, way more complex than futures. Futures are much more stable, and they encompass entire markets, and so they're easier to understand. So overall, futures, in my view, are way, way easier to understand than stocks are. And they are certainly easier to understand than options, because options are a derivative of stocks, and options by themselves have an incredibly complex mathematical formula to determine their value at any one point in time. Futures are the value that they're at, and they have a set tick price. You know how many, if it goes up 5 ticks, you know how much you've made. If it goes down 5 ticks, you know how much you've lost. And they encompass wide markets. They're much, much easier, in my view, to trade. The place where people get in trouble is that they don't understand the products, and they don't understand the effect of margin and leverage. And so they don't appropriately size their accounts, or they don't even bother trading pairs where you're trading hedging one against the other. And that's where you're going to find the real advantage of futures, because you can be in a position where you can control tremendous amounts of capital, put out very little money, and then even if the market crashes, you're not going to go broke, you know, because it's hedging one another, two highly correlated instruments. And in my view, that is a far superior way to trade. Now, there are very interesting strategies that go along with that. And you can also do hedging in stocks just as well as you can do futures. But stocks, like I said, in my view, are far more complex. So that's one of the reasons why our AI is first attacking futures as the setups that it puts out there. The AI setups. I call it the embodiment. I still haven't really come up with a good name for it, but I do call it the embodiment. And if you go to traderofutures.com, you can sign up for that for $99 a month. And this Saturday, I'm giving a class that will teach you how to actually prepare for the risk and trade these setups in the optimal way. So go check that out. It's going to be half price this week, and then that's it as an introductory. All right. It's just the ins and outs within these platforms that I have issues with understanding and using properly. Understand futures as it is, but the platforms are where it tricks me on how to use it properly. Yeah, and I can understand that. But futures, actually trading futures on a platform, again, I think is really no different than trading stocks. And in many ways, it's much easier. The only thing that you have to keep in mind is, when a future contract is going to expire, and avoid being in that position during expiration, or be prepared to roll it from one contract to the next front month contract, which isn't a very hard thing to do. That means getting out of one and getting in the other to maintain your position. All right, so that's everything that I have to say on futures. Well, by the way, on the embodiment, the AI, we are planning on adding stocks to those setups. So if you're looking to get into that AI and futures scare you a little bit, we'll add stocks in there so you can start doing that, and then graduate to futures if you'd like. But I'm not sure exactly when that's going to happen. But like I said, I offer the training program and support. So if you want to get into the futures, or you want to talk to me and find out, that's what I would suggest. Call me, talk to me. Let's see what kind of what the size of your account is, and whether or not this is something that you could support in your account. It's a fantastic strategy. I think it should be in everybody's portfolio that's doing some serious trading. All right. Thank you very much. That's it for today's show. 40 minutes into it. We'll see you next time. See you next video.